pretty much everything. Rather than go through the syllabus, which you've already got, I'm going to kind of list out, and I'll kind of set this up as a starting point for the class. So let's start what's coming. For the next 3 days, you're mine. All day. Okay? You're welcome to participate, ask questions, but the reality is, if you don't participate, I'll keep going. I have 3 days of full stuff planned just in case you're too tired to participate. Okay? Along the way, I'm going to torture you mildly. Okay? So at the start of class tomorrow, there will be a quiz. Why? Because you need a grade and a degree and all the rest of the stuff. Before you freak out, it's a 30-minute quiz. It's open book, open notes, and it'll cover everything we do today. I'll give you more directions as you go along, but not a whole lot more. So you can go out and see what's involved. At the start of day after tomorrow's class, there'll be another quiz covering what we do tomorrow. And then we're done. You think then I can take Friday off? You can. Because there is no quiz on Friday. But there is going to be this project, and in a minute I'll come and talk about it, that's hanging over what you have to do all through this class for the next 4 weeks. I think the due date for the project is February 29th. For the moment, let's just call it the project because it will take over your lives. Before I go through the specifics of the class, I have 3 objectives for this class. The first is I call this a big picture class. The reason I say that, how many of you work in corporate finance? Anybody here work in corporate finance? I mean, when I ask this question in my MBA class, about half the people say, I worked in corporate finance. I worked as a banker. I worked as a consultant. And the reality is, when you work in corporate finance, you work in a small subset of a subset of a subset of corporate finance. Okay? That's not corporate finance. In a sense, I'm going to say, you think you know corporate finance because you've done the same thing over and over for the last 3 years. So big picture basically means I'm going to make all of you elevate and look at the entire process. And I'll be specific about the big picture. I'll actually show you the big picture on a page so you kind of know what's coming. The second is, this is an applied class. I have no time and no patience for theory for the sake of theory. I don't want to do intellectual gymnastics here. I have enough to do with my brain. And I'm sure you do too. So everything we do will be applied in real time on real companies. I've never used a case in 30 years of teaching. Why? Because it seems like a silly thing to do. I'm not taking, abusing people who use cases. Maybe I am, but I have to say that I'm not. But the reason is simple. You have 41,889 live cases in front of you. That's a pretty specific number, right? That's how many publicly traded companies I found at the start of this year. So at the start of every year, and I'll come back and talk about this, I collect every publicly traded company in the face of the earth. I get all the numbers I can, and I look at what the numbers tell me. A little bit of Moneyball, as I call it. You see the movie Moneyball? Okay? It's about all these little rules of thumb. Who comes up with this crap? And why should it hold? Why should 10 times earnings be cheap? So in a sense, I let the data. So there were 41,889 real companies in real time. Why the heck do we need to go back to 1992 and let some Harvard Business School professor tell us what a company did then? It's kind of pointless. Pointless because you know the outcome. So you'll be given a case like, hey, Time Warner buys AOL. Do you think it's a good merger? Oh, come on. We know how that played out. How the heck can you be unbiased and objective? So this is an applied class, applied in real companies in real time. And third, as Sonia said, I have a singular objective. I view myself as an evangelist. I know many of you are not from corporate finance. You might be from marketing, from operations. God help you, even from strategy. My objective at the end of this class is, if this works, I want you rolling down the aisle, say, I see the light now. Because to me, corporate finance opens up spaces. So I'm going to start with a very silly question, and it's a question that I'd like you to humor me on. How many of you would classify yourselves more naturally as storytellers, and how many of you would classify yourselves more naturally as number crunchers? Think about it for a moment. There is no right answer, so don't think about what does he want me to do. This is about you. Are you more naturally a storyteller? Or are you more naturally a number cruncher? You know when that process got started, right? It's probably around the age of 12 or 13. I'll tell you when it started for me. It was after my first English literature class, and I was asked to read Moby Dick. And I read it. And I thought it was about a whale and Captain Ahab. It'll show up in class, and the instructor finds all these hidden meanings in the book. And I said, really? Really? That was there? It's like the Life of Pi. When I read the Life of Pi, I thought it was about a dumb guy who gets on a raft with a tiger. This cannot end well. I read the whole book saying, this is the stupidest book I've ever read. And I show up in class and they say, this is all this. There was no raft. I said, I promise you there was a raft. There was no tiger. So what? There was no tiger? And one by one, every character in the book turns out to be something standing in for something else. And I remember coming out of that class saying, never again will I subject myself to this kind of bullshit in my life. And the rest of my life was charted out for me, which is, never again did I sit in on a social science class. I said, no, I can't deal with this. And my path was Algebra 1, Algebra 2, Algebra 3, Algebra 4, Algebra 5. You graduate from high school and you're off to the races, right? You're an accountant, you're an actuary, you're a mathematician, you're an engineer, you're a numbers person. So think about it. You're On the other hand, there were people who came to that class who thought this was the most amazing thing. There's really hidden meanings in everything. And they came out of that class and said, this is it for me. And then you had English. So basically you had literature 1, literature 2, literature 3. You became a literature major, a history major. And you were off to the races telling stories. There's this mythology about left brain and right brain. The left brain controls logic and linear thinking. The right brain controls imagination. It's almost like we let half our brains die as we age. So if you're a numbers person, you kill that imagination, you bludgeon it to death. Get out of the way. Don't tell stories. It's all not. And if you're a story person, you know how you view the number crunchers, right? I'll let you think about that for a moment. They're the people who crimp your style. You have this great story and they ask you stupid questions like, will it make money? So what? I'm telling a story here. Don't get in the way. Susan, what's this got to do with corporate finance? How many of you are more naturally storytellers? Okay. Here's what I want this class to do. By the end of this class, I want you to acquire the skills to discipline your storytelling. Because the problem with storytelling is it's easy to cross that line. The line I'm talking about is the line between reality and fantasy. You tell a story and before you know it, it becomes a fairy tale. If you listen to some founders describe their companies, you say, wow, that is an amazing story. Hans Christian Andersen couldn't have written a better story. So I wanted to develop enough discipline. That's what this class hopefully will give you, is enough in your toolkit that you can still be a storyteller. You're still going to go back to what you're comfortable with. But you can say, you know what, the story went off the tracks there. I've got to get back on the tracks. How many of you are number crunchers? Okay, much smaller group in this class. Here's what I hope to get out of the class. I want you to develop an imagination, to be creative, to take risks that you're taught not to take, right? That's the essence of number crunching classes. Don't take risks. You have to think like in probabilities and actuaries, like an actuary. I hope that at the end of this class you feel liberated enough that you're willing to kind of walk over that line and say, I can't quite put a number on it, but I can think about it. If I can accomplish this, the 3 days will be well spent. So along the way, there will be times when you feel underwater. Especially if you're a storyteller, you're going to get to those points in this class where you say, that's too much. And you're going to be tempted to say, this isn't for me. I'm going to go back to my familiar ground. That strategy class was so much easier than this one. And what I'm asking you to do is hang in there. Hang in there because even if you miss the little details, hopefully the big picture of corporate finance will give you enough that you can take away from the class. At the same time, if you're a number cruncher, you're going to say, why is he not putting up an equation there? I won't put up equations. I won't solve problems in class. And you're going to complain about this because the quiz is about problems and plugging in numbers and you're never doing one in class. I have zero interest in doing that because that's something that anybody can do. In fact, do you need a body to plug numbers in the equation anymore? If you get a chance, visit the iTunes store. If you have an Apple device, an iPad or an iPhone, type in the word U-value. It's an app that I co-developed with a friend of mine at Dartmouth. It's an app that does valuation. It's a neat app, actually, if I should say so. So if let's say your flight is delayed by 35 minutes. Here's how you can geek out. You know, geek out basically means you're acting like a number cruncher. You can pull up the numbers for a company, plug it into the app, it'll value the company for you. That should scare you because if you're a number cruncher, you're 2 steps away from being outsourced, maybe only 1. It's only a matter of time. So if you think about the world we're going to live in, you need that mix of storytelling and number crunching. Pure number crunchers are going to get crunched, and pure storytellers are going to say things that really don't hold up. Yeah?
Professor, could you just repeat the name of the app?
U-value. There's an iPhone and an iPad app. So if you have an iPad, it's a little easier because you have more real estate to put things on. It's U-value. Okay? I'll come back and so basically you'll find more stuff as we go along. So that's the end game here. You've kind of set up the structure. Ready? We're going to go. I think I have 260 plus slides, which means there will be times during this class, and I warned you, where you're going to say, look, he's moving too fast for me. I'm not going to slow down. I mean, if you stopped and asked me a question, I will slow down. But generically say, can you slow down? It's not going to happen. If you want me to slow down, you got to be specific. Because I'm not sure what slowing down means. Is that what slowing down is? Speak a little slower. Because that's what slowing down is. So if you find that the concepts are flying by you, if you want me to slow down, you've got to make your question specific. So you've got some work to do. Right? Along the way, you will have moments. You know the moments I'm talking about? Where physically you're here, but mentally you leave. It'll probably be after one of those heavy lunches they might serve you, around 2:15. And then you come back, it's 2:25. It's like the Watergate tapes. What the heck happened in those 10 minutes? And I'd be about 7 slides ahead of where you are. Don't try to catch up with me by going back and reviewing the 10 slides, because then you're going to be 10 slides behind me for the rest of the 3 days. Here's what I suggest you do. Jump back into the process at 2:25, wherever I am. These classes are all going to be recorded. So basically all the classes are recorded. I will make sure that those missing 10 minutes are on there, and you can see 2:50 to 2:25. I want to see what's going on. So somewhere along the way, if you find yourself missing stuff, don't worry, just come back in wherever you are and hang in there, because as I said, there is lots of stuff that will be coming at you. Because what I'm going to be doing is taking my usual corporate finance class, which I start teaching in a week to the undergrads. There's a class of 330, and the MBA is a class of 400 in 2 weeks. And it's a 26 session, 15-week class. And we're going to do it in 3 days, which for me is a luxury. Usually I do this class in 2 days, so 3 is like stretching things out. But the problem is things are going to be coming at you quickly. You will not, that's the disadvantage you have when you do things in compressed time, is your brain doesn't get a chance to process things before the next thing lands on. I understand that. So the way I've written the quizzes reflects it, but here's what I'm not going to do. I'm not going to dumb down this class. I'm going to teach this class exactly the way I would teach it to any group. And I actually teach this class to CFOs, I teach it to undergraduates, I even taught it to a group of high school students who wanted to learn more about finance. I teach it exactly the same way. What strikes people as strange? Don't you have to make it more sophisticated? No, there's nothing sophisticated about corporate finance. But what you take out of the class will depend on what you bring in. What that means is, If you worked 15 years in finance, what you take out of this class hopefully will be very different than if you worked 15 years in engineering, which will be different from if you've never worked at all. Okay? Because for the undergraduates, that's really the reality, is they can see an abstract project analysis, but they've never lived through a project analysis, which makes it more difficult for them to connect on some of the stuff, but makes it easier on others. You know why? Because we get set in our ways. And some of those ways, I'm going to argue, are really bad ways. We acquire bad habits while working because everybody does it. That's a one excuse I'm not going to fall back on. Is everybody does it, therefore it's okay. This is not a legal system where precedence matters to me. So if I think something doesn't make sense, I'm going to say it doesn't make sense. And maybe you can explain to me why it makes sense, and that'll be an interesting conversation. So let's get this game going with a very simple question. For the next 3 days, we're going to talk about corporate finance, right? So if we're going to spend 3 days talking about a topic, might as well define it. No fair, don't go to the next page on your slides. Every slide you're going to see from this point on is in the packet. So you don't have to take notes, don't frenetically, copy down everything I say. It's all there. All you need to do is sit back, relax, and try not to fall asleep. And if you do fall asleep, just put your damn head on the table and go to sleep. Don't do that. Just looking at you gives me whiplash. Okay? So don't fight it. Just put your head down, take a nap. Remember, it's all being webcast anyway. Take a nice power nap, come back 10, 15 minutes later. So you ready? Let's start with that question. This is a corporate finance class. We're going to talk about corporate finance for the next 3 days. What the heck is corporate finance? Anybody want to give me a working definition of what this class is about? And Andre?
Yep.
What did you say?
Well, mostly about optimal investment and financing decisions for corporations.
Okay, it's investing and financing decisions. Let's step back. Why do we invest in businesses? Because why do we plant crops? No, it's not just the optimal that I'm going to take issue on. You are right. You did 2 out of the 3, and here's why. You plant crops because you want to harvest them. You invest in projects and you finance them. Why? Because you want not just increase the value. That's not enough, right? You want to harvest the value as an investor. So finish the project. It's investing, it's financing, it's dividends as well. So basically it's about businesses and where they should invest their resources, how they should come up with the funds to invest in these resources, and how they should give the cash back to the owners. If you think about it, that's pretty much everything businesses do. Here's my definition of corporate finance. Any decision that involves the use of money is a corporate finance decision. That's an extraordinarily self-serving definition of corporate finance, because what did I just say? I asked you how many of you work in corporate finance, and about 6 hands went up. You know what? You all work in corporate finance, you just don't know it yet. Because ultimately everything is a corporate finance decision. You're saying, but I'm a human relations person. It doesn't matter. What exactly do your human relations accomplish other than keeping employees working for you longer periods and creating a more loyal employee workforce, which does what? It keeps turnover low, but ultimately it shows up as higher earnings, higher revenues, higher value. No matter what you do, there is a corporate finance component. You're saying, what if I work in a non-profit? Do non-profits think about money? All the time. The only difference between a non-profit and a for-profit is non-profits think about money more than for-profits do. So it's about where do we go to raise donations to keep this non-profit going? What is our objective? So if you're in a non-profit, don't think you don't do corporate finance. You're doing corporate finance except you have a problem. You don't know what your end mission is. And one of the things I'd like you to start thinking about if you're in a non-profit is, and I think this is a fatal flaw in non-profits, is fuzzy objectives. What do you want your non-profit to do? Make the world a better place. Okay. That makes it so much clearer. So when I make a decision, I should make a decision based on which one will make the world a better place. Is that right? Well, okay, I guess that's... But how do I measure better? It's about specifics again. So this might seem like nitpicking, but it cuts to the heart of every entity, for-profit and non-profit. So everything is corporate finance. Our MBA program, before you start the MBA, we have a 1 week, for lack of a better term, I call it brainwashing week, where you're told you've entered this MBA program, this great MBA program, you're brought into NYU, and you're told that everything you've learned in your life so far is a waste, and what you will learn in the next 2 years is the only thing that matters. So this week of initiation, we have lots of faculty come in and talk to the students about what's coming. About 8 or 9 years ago, I was asked to come in and talk to this class because almost everybody in the full-time MBA class ends up in my corporate finance class. It's an elective, but that's a 400-person class. It's almost the entire. So I was asked, can you come in and talk about the corporate finance class? Because everybody here is going to be taking it. And they haven't invited me back again, so there might be a hidden message here. Because I came back with a picture, and I said, this is the way I view my class, right there. Everything else you're going to be doing in this program is in service of my class. That accounting guy is going to act like he's a big shot and says they do these. You know why accounting matters? Because it provides me with raw data to make better corporate finance decisions. The marketing guy is going to come in and talk about product, price, place. I might be old-fashioned. Is it still 4 Ps? Usually they continue to keep adding Ps. It might be 6 for all I know now. Right? Ultimately, why does it matter? Because it drives margins and revenue growth and it drives value. So he thinks he's doing something unique, but he's feeding into my pricing decisions, margin decisions. Operations guy talks about how to efficiently run the shop floor. It feeds into my cost of goods sold, into my value. You name the class, it has a place in my corporate finance class. It is, to me, corporate finance is really about how to run a business using first financial principles. That's the way this class is structured. Not all corporate finance classes are structured that way. I could teach an investment banking corporate finance class. You know what that would be? I mean, what do investment bankers, you talked about the investing decision, the financing decision, the dividend decision. Which of those 3 decisions do investment bankers get most involved in? I wish it was the investing decision. But basically, the investing decision is usually left to companies. You want to open a new factory. It's the financing decision that investment banks come in. Because investment banks act as the nexus between you and capital markets. You want to raise capital, you got to go to an investment bank. You want to do a really bad, big investment, you go to an investment bank. What am I talking about?
M&A.
You want to do an acquisition, and I will talk about this, and I'm extraordinarily caustic about how M&A has destroyed more value at businesses than any other single action that companies take. You go to investment bank. If this were an investment banking class, we'd be focused in on what's the right mix of debt and equity, how should we do this, when in fact it's just one small piece of a much bigger puzzle. So this is a big picture corporate finance class, and I'm going to start off by shifting mindsets. So when did you do your accounting class? You've done one, right? Last week. I have some very bad news for you. My first job is to cleanse your mind of everything you've learned in accounting. And let me explain. This is an accounting balance sheet, right? Let's do some very simple accounting 101. Assets, liabilities. Let's think about how accountants see the world. If you have long-lived real assets, plant, equipment, how do you record it in your balance sheet? What do you do? You showed what you paid for it up front, and then the accountant does this stuff over your life where he says, this is how much the asset lost. It's an accounting depreciation. Let's take it for what it's worth, but that's how fixed assets are recorded. If you have current assets, accounts receivable, inventory, it's usually recorded what you paid, which happens to be pretty close to what the cost might be today. So already you can see the difference in principles between long-term fixed assets and current assets. If you have financial investments in other companies, what am I talking about? You own 5% of another company, 10% of another company, Yahoo owning a piece of Alibaba, or Yahoo Japan. How is it recorded on balance sheets? at what you paid originally for the investment with some adjustments in. So if you look at Yahoo's balance sheet, their Alibaba holding is recorded at $1.5 billion. They own 14% of Alibaba. You know what 14% of Alibaba is worth today? Close to 22 billion. You think that's not real? It's not the accountant's job to be real. Its accounting is driven by its own forces. In this case, financial assets get recorded at what you originally paid for it. And then you get to intangible assets. Sounds fancy, right? So if I think about intangible assets, not like an accountant, not even like a finance person, I can think of lots of big assets. So if I'm talking about Coca-Cola, what's the biggest intangible asset in Coca-Cola? Branding. If I'm talking about Apple, what's the biggest intangible asset in Apple? Coolness factor, styling, whatever. I mean, you can list out. What I'm saying is there are lots of intangible assets in lots of different companies, and we can name them all. But if you look at accounting balance sheets, 90% of intangible assets in accounting balance sheets are one item. What's that item? Goodwill. The worst name and the most destructive asset created in the history of accounting. And here's why. For goodwill to manifest itself on an accounting balance sheet, what does a company have to do? It has to do an acquisition. So let's start off here. If you're the greatest company on the face of the earth and you've grown entirely with internal investments, how much goodwill will there be on your balance sheet? Zero. The minute you do an acquisition, goodwill pops up. And what does it measure? Let's see how much brainwashing you've gone through in your accounting class. What's the difference between? Come on, you can take a risk. How does goodwill get measured? It's the difference between what you paid and... I'm glad you said book value, not stuff like fair value. There is nothing fair about this value. It's accounting book value dressed up. You pay accountants a lot of money to dress it up. It's called purchase price allocation. And if you're an accountant, this is make work for accounting day. That's basically what it is. You're moving the chairs on the Titanic after you've hit the iceberg. Let's face it. And if you overpaid in an acquisition, an accountant can't rescue you at purchase price allocation. He can just say, you overpaid. Move things around, make it look a little better while you're going down. So it's a difference between what you paid and book value. And here's why you have to put it in. Let's say your book value is $4 billion for the company you're acquiring. You paid $10 billion. You got a $6 billion problem to explain away as an accountant, right? Why until yesterday, what was the accountant saying? It's worth $4 billion, it's worth, oh, oops, it's worth $10 billion. So he takes the $6 billion, he puts it on the balance sheet. And why do you need to put it in the balance sheet? Because the balance sheet has this very unpleasant requirement, which is it has to balance. Goodwill exists for one reason and one reason alone. It's a plug variable to make the balance sheet balance. You know what the problem with goodwill is? It sounds good. And when something sounds good, you feel the urge to pay for it. In my the other hat I wear is my valuation hat. You'd be surprised, or maybe not so much, at how many emails I get from people valuing companies. So I'm finished with the valuation, but there's $6 billion of goodwill on the balance sheet. How much should I pay for it? You feel like slapping the person around the face saying, wake up. It's a plug variable. What the hell are you doing paying for a plug variable? But I blame accountants for this. By naming it goodwill, I know how many billions of dollars have been spent because it's called goodwill. Maybe we should go back, and here's my proposal. And I make these proposals to accounting, and they seem to ignore me every time I make them. I said, why don't we just rename it? Call it plug variable. X. How about that? Because that's all it is. There's nothing behind it. And on the other side of the balance sheet, of course, the same logic rolls through. You've got current liabilities, accounts payable, supplier credit, deferred this, deferred that, deferred everything under the sun. Those are marked pretty close to market because you took them last week, last month, 6 months ago. Then you got long-term liabilities, bank loans, corporate bonds. These are recorded at what you raised at the time you made these issues. So if interest rates have changed, the accountant says, oh, I can't do much about it. And then you got shareholders' equity. You seen that in the balance sheet, shareholders' equity? So if I open up Coca-Cola's balance sheet, there's a shareholders' equity, $14 billion. So let me ask you a question. What goes into shareholders' equity? Everything you've done in your life as a company is in there, right? That initial IPO that Coca-Cola did, which is what, 100 years ago, is in there. And every retained earnings since. You're saying, what's wrong with it? Nothing wrong with it, but remember, it records the past. And that's the first thing I want to remember about accounting balance sheets, is they're backward looking. Not because accountants are not trying, but because that's their job, is to record the past. Accountants are historians. And they're recording history. Unless, of course, they get delusions of grandeur and try to do stuff they shouldn't be doing, which is forecasting, which is fair value accounting. An oxymoron if you think about it, because you can either do value, you can do accounting, you can't do both. So an accounting balance sheet is backward looking. Accounting is rule driven. You know what I'm talking about, rule driven? I still remember when the accounting rules for fair value accounting were being written. They asked me to come in and talk to the panel doing it. Initially I resisted. I said, I don't want to do this. They said, no, why are you out? So I said, what should I read up before I come in? What is the rule? And they sent me the rule that they were thinking about writing for fair value accounting. It's at FAS 157. You know what freaked me out about that? Was the 157. You know why it freaked me out? There are 156 other rules I don't even know about. That's the nature of accounting. Open up international accounting, open up FAS. What will you find? Hundreds and hundreds and hundreds of rules. Accountants, when they get in trouble, will write more rules. And this might seem harsh, but that's exactly why accounting will never be able to value assets correctly. Now I teach my valuation class. I tell people way up front that in accounting, for every rule, there are 100 exceptions. And how good you are at valuation is really a question of how do you deal with the exceptions. This is all about exceptions. And accounting is rule-driven. So accounting is backward-looking. Accounting is rule-driven. So you ready? We're going to switch mindsets. This is an accounting balance sheet. I'm going to replace it with a financial balance sheet. A financial balance sheet at the surface looks very much like an accounting balance sheet, right? You've got assets and you've got liabilities. But here's the way I see the world. When I look at a company, I break your assets down into investments you've already made as a company. I call these assets in place. And growth assets. What are growth assets? This is the value I'm attaching to investments I expect you to make next year, 2 years out, 5 years out, 10 years out, forever. So think about it. There's no fixed or, I really don't care whether your assets are tangible or intangible, fixed or current, is have you already made them or are they in the future? And I have room to roam. I have no rules that apply to me. Nobody can say you can't do this, you can't, don't even try to do that because it doesn't apply to me. It's a financial balance sheet. And on the other side of the balance sheet, there are only two items. There are only two ways you can fund a business. You can borrow the money or use your own money. You can dance around these two choices as much as you want, but we call borrowed money debt and your own money equity. Now, of course, with a publicly traded company, one can be stock and the other can be bonds, but generically any business, if any of you own a private business, the funding doesn't appear magically. It either has to be your money or borrowed money. You say, what about family money? It's because they view you as an extension of the family that you're getting that money. It's still your collective money, debt or equity. It changes the way we think about the world. Finance is forward-looking. Finance has very few rules, and that's great news because over the next 3 days I'm going to hammer home those same 4 or 5 principles, and by the time we get to Friday you would say he's saying the same thing over and over again, and that's good news because that basically means you've cracked the code on finance, and once you crack the code there are no mysteries left anymore. You can deal with any problem. So that's my hope, is that by the end of the 3 days, or even if not by the end of the 3 days, while you work on you will start to see that we're going back to the same 3 or 4 or 5 principles over and over again. So to kind of set this up, I'm going to give you 2 contrasting companies. Okay? So you guys are going to be looking at Microsoft. Everybody's familiar with Microsoft, right? And you guys are going to be looking at Snapchat. Familiar with Snapchat? A Snapchat is this app you put on your phone that teenagers love. And if you have it on your phone and you're 45 years old, I'd be seriously concerned about your mental state. Here's what Snapchat's biggest strength is. Somebody want to tell me what my daughter actually sent out 3,855 Snapchats just last year. Okay? What's Snapchat's biggest strength?
The content disposes after 24 hours.
No, not 24 hours. 15 seconds. 15 seconds. You take a picture, you said, at least in theory, it disappears in the ether space in 15. You see why teenagers and 22-year-olds like it, right? There are pictures you take, you say, I should never have done that. You put it on Facebook, it's there for eternity. With Snapchat, people see it and it's gone. So let's look at these. So your job is Snapchat, is to track Snapchat, and we're going to use a financial balance sheet to kind of look at these two companies. When I look at Microsoft, and I look at the investments it's already made, what are the investments that Microsoft has already made that create value for it? Keywords that create value. Now, R&D is not an investment. R&D gives rise to investments. There are only two things Microsoft has done in its life that have made it money. One is called Office. The other is called Windows. We can dance around this as much as you want, but everything else it's done in its lifetime has either, the way Microsoft usually works, it comes up with a new product, but 3 years later it didn't work, it writes off $3 billion. So every new product for the last 20 years, and I might be harsh when I say this, but it's only a matter of time before Surface gets written off. I might be cynical, but that's the way it is. So let's think about it. Are Windows and Office valuable assets? These incredible cash cows, right? I know there is this little worry that's eating away underneath those assets, which is, as we move away from desktops to devices, it's possible that our attachment to Windows and Office will go as well. But for the moment, two incredibly valuable cash cows, and probably worth $240, $250 billion, just in terms of the collective cash flows. So the value of assets in place is a big number, 250. What's the value of growth assets at Microsoft? I've kind of given away what I think about the growth assets. If you're lucky, it's zero. See why it's if you're lucky? If they keep doing what they're doing right now, what is it going to be worth? It's going to be minus 20. But how can that be? Hey, you keep screwing up my money. After a while, these guys can't stop screwing up. It's a definition of insanity to keep doing the same thing over and over again, expecting a different outcome. But these guys are insane. So for Microsoft, most of their value, maybe even more than 100% of value, comes from assets in place. Very little value from growth assets. So even if you believe the new management changes, we're talking about, at the margin, relatively small value from growth assets, the bulk from assets in place. Let's go to Snapchat. What business is Snapchat in? Social media is not a business. Apps are not a business. .com is never a business. So let me ask you a question. When I ask you what business is Snapchat in, I'm asking how do they plan to make money, right? My daughter with 3,855 Snapchats is just Snapchats. It's pictures floating around. So it's advertising, hopefully. But they have a problem. You know what the problem is? What's their biggest strength? Is you take a picture, it disappears in 15 seconds. See? You want your advertisement to disappear in 15 seconds? I don't think so. And this is a struggle they face, is how to convert this intensely loyal user base into revenue. So right now, you know what the revenues are? Zero. So what's the value of assets in place? Zero. But they do have a lot of loyal users. And we can debate how much value might come from that. But last year, venture capitalists priced Snapchat at about 15 billion. 15 billion. Billion, not million, billion. Right? That number was written down to 12 billion this year. But we can debate what it's worth. But the bulk, all of Snapchat's value comes from growth assets. And we can talk about whether it's 2 billion, 5 billion, 7 billion, 12 billion, or 20 billion. You know what? Corporate finance just got really simple. Andre mentioned there were three big decisions that every business makes that we cover in corporate finance. The investing decision, the financing decision, the dividend decision. The investment decision talks about how much time should we be spending looking at new investments, and how should we, measure the returns on these investments. The financing decision looks at how much can we borrow. The dividend decision looks at how much can we return to it. So you ready? You're Microsoft. How much time should you be spending on the investment decision? Don't. Get out of the investment decision, because every time you've looked at the investment decision for the last 25 years, what have you done? You ruined my value. Send the R&D guys back home. Get rid of all the analysts you have in the company. Let it go. Growing old is never fun. But you are old. You're saying, I'm only 25 years old. Tech companies age in dog years. You're like a 1,000-year-old man now. Forget, maybe an 80-year-old man, 85, and you're trying to do gymnastics. Nothing good will come out of this. So let it go. So that takes a lot of pressure off them, right? How much can they afford to borrow? You got 2 cash cows throwing off huge amounts. They can borrow a lot of money and service the debt. Can they afford to return a lot of cash to their stockholders? Almost everything, because I said I took the pressure off and said you don't have to invest. So you can, so Corporate Finance 101, your investment decision got really simple. You can borrow a lot and pay a lot out in dividends. You're done. Yep.
That's the historian's view of things.
No, it's in fact, it's the exact opposite of historian's view. Historian.
Let me make my point. You're basically saying the last 20 years everything they attempted did not work, so nothing is going to work in the future too. That's really a historian's view of things.
No, that's not true. I'm saying your history tells me more. Because if I asked you, do you have good investments of any management anywhere in the world, what are they going to tell you? We've changed. Everything's different. So you know what I use history for? As an anchor for your claims. So if Microsoft comes in and says, we have these great products, I look at that with an incredible amount of skepticism, because your history works against. It's not, it's your history you're fighting against. And you want to fix that history, you know what you have to do? Make Surface a successful product. There is, however, when you repeatedly try and fail, it might be that we act as if, and this is, I think, part of the problem, the way we teach business is, if you're good enough as a manager, what do we say you can do? You can create miracles, reincarnation. I was just in India last week talking about corporate life cycles. Reincarnation, will be born 7 times? No, it doesn't quite work that way. So we'll come back and talk about reincarnations, because we can talk about companies that have come back from the dead, right? Can you name them? Apple, IBM. What's the fact? What is the fact that we can name these companies tell you about this process? That these are the exceptions rather than the rules. More damage is created by managers trying to be exceptions than the rules. And I think the reason I'm not as emotionally attached to what's a corporation? It's a legal entity. It's a legal entity. There is no emotion. I think we get emotion. The company has to survive. Corporate sustainability. Who comes up with this stupid objective? What the heck does that even mean? Sustain a corporation. That's like a mummy. Right? The Egyptian mummies, you stuff them, you put them in the tomb. There's nothing. I think we need to let go emotionally. And part of the problem might be that there's a certain point in a company's life cycle where their history starts to work against them. Both Google and Microsoft have a problem. You know what that problem is? They have an incredibly successful product that feeds into all this other stuff. It's like having a sugar daddy. You know what a sugar daddy is? You're a 22-year-old, your father or mother is the richest person in the world. You can be incredibly sloppy about the businesses you start. And finally, Google came to that same realization last year, right? Which is part of the impetus in the renaming of themselves as Alphabet, which I thought was a stupid name. It really, but at least the motive is, it doesn't, the way we've structured ourselves as a company, we've tried everything. We've told people to think like, startups. But you really can't think like a startup when you know that there's a big cushion behind you. So I'm not contesting the fact that companies sometimes come back. And maybe Microsoft will find a way back from the dead, but given everything they've tried in the last 20 years, As a stockholder in Microsoft, it strikes terror in my heart every time they talk about, and I'm an actual stockholder, and I hate the company, which actually is something I want to say. You can hate the company and love the investment, and love the company. I love Amazon. I will not buy it at $600 per share. So we'll talk about that debate investors can have. So is it possible that Microsoft could come back from the dead? Yes, but you cannot manage a company on possibilities. It has to be plausible. And right now, I think the pieces don't seem to be in place. But again, we're debating how much value. We're not talking about 100 billion in value. We're talking about, can it be zero, maybe plus 10 billion? Your best days are behind you as a company.
Well, if it's that simple,
Yeah.
why aren't they changing their strategy? Is it more humans
Okay,
than
let's say,
anything else?
it's part of it is if I make you the CEO of a company, like Marissa Mayer, right, 2012, when she was brought into Yahoo, did anybody actually think that Yahoo could come back from the dead? There's no way. I mean, are you actually, I don't even remember the last person I talked to who used the Yahoo search engine to look for something. And the only people I know with Yahoo Mail seem to be 75-year-olds in Asia. There must be a lot of them. But I think the problem is in 2012, you looked at Yahoo's revenues and margins. The decline was obvious. But when she was brought in, what was she asked to do? Turn the company around. This is, I call this the Steve Jobs syndrome. Steve Jobs did turn Apple around. He became a legend. So if you're brought in as a CEO of a company, I give you two pathways. You can gamble it all and bet it all on going big. And if you succeed, what happens to you? You'll have movies made about you, books written about you. You will be the next Steve Jobs. And if you fail, what do you say? I tried. With somebody else's money, but I tried. I think it's actually an extraordinarily destructive process we've set in motion. We've made CEOs celebrities. And we tell CEOs who make companies big are good, and CEOs who might do the right thing. So if you're brought into Microsoft and you actually shrink the business, nobody's going to write your story. You're not going to have movies made about you. You almost need a different type of person coming in as CEO. In fact, I actually did these prototypes of what kind of person you need at each stage in the life cycle. Early in the process, you need visionaries, right? Elon Musk, startups, young companies. As you age, you need builders. I call him Bob the Builder. You know, I watch my kid. Then we need defenders, people who can defend. And at the last stages, you need Larry the Liquidator. Okay? If you've ever seen the movie Other People's Money, Danny DeVito plays this guy called Larry the Liquidator. That's who you need. Larry the Liquidator he's Danny DeVito. Think about that. That's your prototype for a company in decline. Not Gregory Peck, but Danny DeVito. I have this view of the corporate life cycle that strikes people as almost fatalistic. But I think that the reason I'm okay with it is corporations to me are legal entities. And maybe the only way to be in a startup is to start all over. As an investor, you pay cash out. I put it into companies that are better suited to play that startup game. And I'm open to the possibility that you could be the next IBM or the next Apple as a potential turnaround. But I'm not going to make you make decisions on that basis. Yes?
Could I just ask, building on Joy's point,
Right.
going back to your Microsoft case,
Yeah.
if we subscribe zero value to R&D going forward,
John, can you?
Yeah. The question is, the mics actually work here? Just remember to turn them off when you're done though.
If we're building on
Right.
Bajoy's case, or your case and Bajoy's point on Microsoft, if we subscribe zero value to R&D going forward, and
It's actually worse. It's negative value to R&D.
or negative value to
Yeah.
R&D going forward, how do we square that with the fact they did create Windows and they did create Office?
Because early in the life cycle, R&D is not always a negative value. So if you looked at Microsoft's history, early in the process, their R&D was value creating. In fact, this is true for every successful business. Early in Pfizer's lifetime, in Merck's lifetime, R&D was an incredibly productive investment. For the last decade, collectively at pharmaceutical companies, R&D has been worse than a zero-sum investment. It's been value destructive. Some of this is the companies aging. Some of this is the entire sector changing. 30 years ago, R&D was an incredibly productive asset in pharmaceutical companies in the US because it was a price plus. Basically what you did was you took whatever costs you had and you pushed it through to your patients. Today we're in an environment where cost structures are getting tightened. You're negotiating with large insurance companies. Your pricing power is being reduced, even though you might not get that sense by looking at big stories about raising price. But R&D has become a negative value asset. And all I'm saying is, as companies age, they have to be aware that they're not playing the same game they played 15, 20, 25 years ago. And that's tough to do. It's tough to do because you came up through the ranks of the company, it was a young growth company, and it's so much more fun, I'll admit it, managing a young growth company than managing a mature company. And it's a lot more fun managing a mature company than managing a company in decline. Some of you might actually be working at companies in decline, and you will notice the perils of this every day that you work. Because you're not talking about picking great investments. It's what's the least damaging thing we can do with the money? That's a bad place to be as a business. So as we go through, we'll talk about bad businesses. There are businesses that I think have become bad businesses. The automobile business, for instance. And I say, what do you do when you're in a bad business? And corporate finance is going to give you a very simple answer, which is, if you're in a bad business, stop investing. You might not be able to get your money out because it's too late, but stop investing. You heard of Sergio Marchionne? Sergio is CEO of Fiat Chrysler, one of the largest. If you get a chance, online, if you go online and search, he just put out a presentation 2 years ago that I found astoundingly honest for a CEO of an It's called Confessions of a Capital Junkie. It's exactly the title of the presentation. And what he talks about is the fact that the automobile business has imploded as a business. He said, we cannot keep doing what we're doing. We're investing billions of dollars in R&D. It's something that automobile companies didn't used to do, but it's stick. And we're not being able to make money back. Revenue growth has dropped. Margins are decreasing. We're investing more and more. We're in a bad business. You know what the other CEOs, the other automobile companies said? No, I don't hear you. They're in denial. And part of the reason for that is when you're inside the business, you're running companies, you so want that reincarnation that you're willing to kind of push the facts to the side. Gabriella, the question? So let's move to the more optimistic scenario. Snapchat, right? Investment decision matter a great deal to you? Yeah, this is all your value comes from, is if you can convert users into ads. So everything you can do to make that conversion is huge. How much can you borrow? Don't think too long. Go with your gut. Nothing. And here's why. When you borrow money, what do you have to do? Make interest payments. You're saying, but I have a lot of promise and potential. Try that with a banker. Go say, look, I don't have any money, but I have a lot of promise and potential. And if you fail to make an interest payment, what happens? The game is over. So you could be the most promising company, but in a sense, you put yourself at risk. For what? Because you thought you could borrow money. I was in India last week, and I was talking about a company called Flipkart. Flipkart is one of those big success stories in India. Its market cap is at 12 billion. It's an Indian online retail company. And of course, the promise here is 1 billion people. Big market. Now, all that promise. And we can debate it. I think it has lots of promise and potential. But they did something a few weeks ago that I found almost inconceivable. They borrowed money. They said, this doesn't make any sense to me. It doesn't make sense because with all this promise and potential, why would you risk it by borrowing money? You say, what other choice do they have? What other choice do they have? Go raise equity. You're saying, but I have to give up some control. Would you rather control a bankrupt company or take a smaller slice of a healthy company? And this is something we're going to talk about today as we go through some of the companies. Is in many companies, unfortunately, especially family-run companies, you know the answer they give you? I'd rather control a company in trouble or bankrupt than give up control. That desire for control is so overwhelming in some business that you see managers doing things to essentially make sure they control. And sometimes you might have to give up some control to get some help. But in the case of Snapchat, you shouldn't borrow money. How much should you pay in dividends? What do you have to pay out? So corporate finance became very simple for you. Spend all your time in the investing decision. Don't borrow money. Don't pay dividends. Rahul?
In the same example, financial view, if we take the company like Coca-Cola.
Yeah.
So you will value.
So let's say Coca-Cola, because your story about Coca-Cola is going to animate this balance sheet. Most of the value comes from assets in place or growth assets? Assets in place. Is it a pretty safe assets in place, or is it coming under potential assault?
No, under assault.
I'll tell you, both McDonald's and Coca-Cola are having, it's a long-term problem eating away,
0.2.
which is, you drink a lot of water with additives and sugar, and 16 teaspoons of sugar, you are going to die sooner rather than later. We're all going to die, but that's eating away. So it's a most valuable asset in place, but also there is a, and the growth assets from 30 years ago is where did they go global? Oh, I'm going to give away the answer. 30 years ago when they wanted growth, they went global. It's another global company.
But what I was
Yeah.
coming to was that in that case, like the
Yeah.
accounting says goodwill because you're selling water at a price. So
No,
that's because of
no, that's not true. Accounting doesn't call that goodwill.
No, but if they were to sell the company, I'm just saying.
If they were to sell the company, it has nothing to do with the syrup. If their book value was equal to 200 billion, they sold it 200 billion, there'd be no goodwill. So don't read into goodwill anything more than it's a plug variable. I think we feel this urge to attach all this stuff to goodwill. There's nothing behind it. So when they sell their business, whether there'll be goodwill or not will not depend on whether the syrup is a good syrup. It's what their book value is relative to what they sell it. So if they sell it book value, there will be no goodwill.
The second point
Yeah.
you said about automobile. Now,
Right.
if the company stops investing, it will go faster down. Like
No, back up again. Is that true that when companies stop investing, they'll go faster down? It depends on what they're investing in. HP over the last 6 years has done 2 $8 billion acquisitions. God, I wish they hadn't. Because 3 years after they did each acquisition, they wrote off all $8 billion. Don't make that assumption that investing less will mean invest. There are lots of companies where investors. In fact, this is a great time to introduce a notion. Every year, at the start of the year, I said I look at 41,889 companies. I look at two very simple numbers, and I'll come back and talk about these. I look at their cost of capital, which is what it costs them to raise money, and I look at the return they make on their existing assets. We haven't gone into detail, but you can give me the intuition. If it costs you 9% to raise money, you want to make, come on, fill in there, more than 9%, right? So the question I asked was, out of the 41,889 companies on the face of the earth today, how many earn more than their cost of capital? Give me a guess. It's about 46%. 54% of all companies globally earn less than the cost of capital. Coming back to you, every time they invest, what are they doing? Destroying value. That's a scary thought. Say, how do I make them stop? This morning we want to talk about corporate governance and make this about fancy stuff about directors and boards of directors, are they independent? That's really not my definition of corporate governance. You know what the definition of corporate governance to me is? Is can I stop that company that is deliberately destroying value from doing that? And if I cannot, I have poor corporate governance. Okay? So we'll come back to that because I think there are lots of preconceptions we have. Growth is good. Says who? Investing is good. Why? R&D is noble. Who comes up with this stuff? Maybe some R&D scientist. It's noble. We have to keep doing it. Okay? There's nothing. This is a business. There is nothing automatically good or automatically bad about investing or R&D. You have to look at the business. In some companies, do I want them to invest a lot in R&D? Absolutely. In other business, do I don't want them to stop right away? Absolutely. Okay?
but
Did you answer to yourself sometime? Why do they do it? Is it hubris, fear,
All-
paranoia, inertia? What?
It's human nature. How many people have facelifts every year? Thousands and thousands of people. Tummy tucks? Hundreds of thousands of people. Why do we do it? Because we all want to look 25 for the rest of our lives. Why do they do it? Hey, no. That desire to be young is not just restricted to human beings. It expands to businesses as well. So I think I understand why they do it. So all I have to think about is, how do I get these people to look in the mirror? How do I get Joan Rivers to look in the mirror and say, this facial stuff has gotten out of control. I can't even smile anymore. I've got this. So it's partially just making managers face up to reality.
You must be
Actually, I don't mind, right? So, yes.
Professor, could you talk a bit to your growth statement? I see our companies under pressure every morning to deliver growth.
Growth in what? In earnings per share. And why are you playing that game? Because you think equity research analysts set your stock price. That's a fundamental problem that lots of companies have. Do you think equity research analysts lead the market? Let me ask you a different question. When do sell recommendations start showing up in a company like Valiant? When did equity research analysts tell you to sell? After the price had dropped to 70. When did they ask you to buy? When it peaked. Equity research analysts are followers rather than leaders. Good companies have to stop playing the equity research analyst game. Okay, we'll talk a little bit about Amazon through the course of the next 3 days. It's a company, as I said, I love as a company, I hate as an investment. But it tells you the value of having a CEO who essentially sets the rules of the game. Because right from the start, what has Amazon said? I call it the field of dreams model for running a company. Remember the movie Field of Dreams? Where this guy, Ray Kinsella, builds this baseball field in the middle of Iowa, I think. And he says, if I build it, they will come. Who's they? All these mythical baseball players. You say, what's this got to do with Amazon? What's Amazon's story? What is the story they've been telling markets? If we build it, revenues, they will come. What's there? The profits. And the amazing thing is, 20 years into Amazon's life, investors are still okay with it. Why? Because you have a CEO who's never played the equity research analyst game. And by being so consistent and acting consistently, guess what? Now analysts play his game. Every time Amazon comes out with the new earnings report, guess what they look at? They say, oh, Jeff Bezos said earnings don't matter, so we're not even going to look at the earnings. We're going to look at revenue growth. It's amazing that he's been able to do it. But that's the lesson I think I wish more CEOs took out. Because so I agree with you. We play this dance. What do the analysts want? They want 16 cents more. How do we deliver 18 cents more? Do you see how disruptive and damaging this game can become after a while? Because you're going to be cutting R&D. Say, if I cut R&D this quarter, even if it's creating value, I can beat the 16 cents. It is truly a game that gets out of control very quickly. So it's again something we have to come back to. So as we go through, we'll talk about it.
Just on the point of R&D, isn't it sometimes more of a strategic choice than just human nature? Like
I wish you hadn't used that word. I'll tell you why.
Just give you an example. In the auto industry, the industry knows that they're moving towards the hybrid, electric cars. So all of them are racing. That's not where they spend.
See, that's not where they're spending the R&D on. 95% of the R&D at automobile companies is going into what? Basically small stuff. Like how do we make that windscreen look brighter, or how do we make the GPS fit into, so there is, but the reason I said the word strategic freaks me out is, you know when the word pops up? The word strategic, and I'm not picking on you. The word strategic basically means the numbers don't fly, but I really, really want to do this. Now, if you don't believe me, next time somebody uses the word strategic, think of when they use it. Okay? We're going to this market, we're going to lose money, but it's strategic. Nobody ever talks about strategic if you're making money. Are there strategic considerations? Yes, let's start to be specific. You want to go to China because it's a big market? Let's talk about the big market. In fact, in my valuation class, I call these weapons of mass distraction. Because words like strategic, disruption, that's the new word. They throw these in, nothing else, throw it in. China, that used to work a lot. China, everything's going to explode, right? Synergy. We have all these words floating around. So I think there is a case to be made that the business is changing. But maybe the reality is you're not equipped to play in that business. Okay, that's not an automobile business anymore. So sometimes that's part of the process of saying, look, we're not equipped to play that game. Maybe we should have a joint venture with Google or Apple. So I'm not saying you can't invest, but you have to invest sensibly. You can't just say, trust me, the business is changing, therefore I have to invest. Rahul.
In the same automobile.
Right. Are you not working for an automobile company? So why are you so fixated?
No,
Okay.
in the same thing, if say BMW launches 6 new models and Mercedes does not, so the sales in
That's a good question. You're saying the only way I can survive in a bad business is by investing more.
No, because the competitor is giving.
No, but I'm just reframing your question. You're saying if it's a bad business and everybody else is racing to the bottom, should I get there first? My advice is, if you're in a bad business, let them kill each other. In fact, in many bad businesses, the best thing you can do is nothing. It's amazing how quickly they will destroy themselves. So let them introduce 6 new models. See how well it works for them, right? So again, that's another part of what drives decisions, right? Everybody else is doing it. And remember what I said, everybody else is doing it is not good enough as a reason for making decisions. So as we go through, we'll return to these concepts. I want to kind of move on, partly because this is something that's going to be underlying almost everything we do. I'm going to come back to this. I'm going to piss you off no end, and I really don't care. Right? I'm not here to make you feel comfortable. In fact, whenever I go to seminars, or I don't do consulting, but I go in and talk to different groups, I have a name tag I've made for myself. So that's what the modern shit disturber. Because that's my job, to go in and say, hey, I don't. So in a sense, I'm going to stir up the shit here. I'm going to throw things that you might take for granted, and you can disagree with me. Right? That's fine. But I want you to think about why we have no facts, we have beliefs. And sometimes it's good to take those beliefs and put them in the microscope and say, we've been told all our lives that R&D is good. Why? We've been told that growth is always great. Why? Because I think unless we do that, and I'll do the same thing with things I take for granted. Okay? We've been told risk is bad. Why? Because that's part of what I want to do in this class, is bring these things to the surface so we can kind of re-examine those. So I'm going to show you the big picture of corporate finance. Do you have a quick question? Yeah.
If you believe in the notion of a corporate life cycle, then what distinguishes, or when do you notice it change from growth to mature, from mature to end of life? I mean, what are the things that trigger?
There are bar mitzvah moments in a company's life. Any of you Jewish? You know, if you're Jewish at the age of 16 or 17, there's a growing. There are bar mitzvah moments in a company, and there are these transition points, and the transition points are often noticed when you get to them. And what separates good companies from average companies is good companies know they're coming. I'll give you an example with young startups aging. When you're a young startup, let's say you're a social media company. How do I price you? Notice the word I use. VCs don't value these companies, they price you. So how do you get a high price as a social media company? What do you point to?
Users.
Users, right? And for the moment, I'm okay with it because that's all I see. So I say, you have more users, I'll put up a higher price. You know what the bar mitzvah moment is? Is one day magically it says, oh, you have a lot of users. When are you going to start making money? You say, what? I have to make money? When did this happen? And if you're a public company, guess what happens? Your stock price implodes because people see no plan. Remember the bar mitzvah moment Twitter went through a few months ago? Which is people stopped saying, because Twitter thought the game was about delivering users, and all of a sudden the game changed. And that's the difference between Twitter and Facebook. Facebook, for better or worse, has been managed on 2 channels. One is, they went for users. How do we know?
He tells us.
Not only does he tell you, he bought WhatsApp. Why did he buy WhatsApp? How much money was WhatsApp making? In fact, in Asia, I asked this question, how many people have WhatsApp? In Asia, almost everybody does. Then I asked, how many of you pay for WhatsApp? 3 suckers put up their hands. What? And yesterday he took away even that illusion, right? If you read the news story, he says, I'm not going to, because the reality is that, so why did he buy WhatsApp for 19 billion? It came with 450 million users. So he's playing the user game, and if that's all he played, he'd have had his own version of a Twitter moment. But Facebook, right from the beginning, has also been very, very active, even when the market wasn't looking at it, converting these users into revenues and profits. So when Facebook's bar mitzvah moment came around, they said, when you start, oh, we're already making money, you haven't been noticing because you've been so focused on the users. That's what, to me, separates well-managed companies from badly managed companies, is recognizing that the transition is coming and managing. So if you're a mature company heading towards decline, You've got to start changing the mindset in the company about investing. You have to act consistently with the client, and you have to deliver messages to the market, preparing them for the fact that you're not a growth company anymore. And that takes courage sometimes, because as I said, some equity research analysts are going to say, but that's terrible, your growth in earnings per share has dropped off. You say, tough. Okay? That's who I am right now in the life cycle. So we'll talk about those transition moments in the context of looking at businesses. So let's look at the big picture of corporate finance. As I said, there are three big decisions that corporate finance is built around: the investing decision, the financing decision, the dividend decision. Remember I said this is a big picture class? This is it. If you get this page, you got corporate finance. The rest of the 3 days is icing on the cake. And I really mean it. This cuts to the core of the intuition, the first principles that drive corporate finance. Let's start with the first decision. The investment decision says that when you go out and make investments as a business, you want to make sure that those investments over time, doesn't have to be in year 1, year 2, but over time, earn a return that is greater than some minimum acceptable hurdle rate. I've thrown a buzzword in there, right? If you've not taken it, say, what the heck is that? I'm not quite willing to put details on it, but I'll give you the sub-principle that's going to govern how I think about the hurdle rate. That hurdle rate should be higher for riskier investments and lower for safer investments. Does that make sense to you? If I take a risky project, I should be setting a higher hurdle rate. We'll talk about how much higher and lower. I haven't filled in the details, but that's a sub-principle. And when I talk about returns, those returns on projects should be based on cash flows, as opposed to what? The bottom line accounting earnings. Why? Because you can't spend earnings. Try. It's tough to do. It's going to be based on cash in, cash out. Should reflect when you get those cash flows. What do I mean by that? Would you rather get $1 billion today or $1 billion a year from now? You don't. Again, as I said, it's instinctive. My kids knew this at the age of 4. Brilliant financial geniuses, because I used to offer, they get an allowance, and usually the allowance is on Saturday with each kid, just to test to see if I should be setting money aside for a college fund. I would ask them a question. Would you rather wait till Saturday to get your allowance, or would you rather get it on Monday? If they thought too long, I said, you know what? I don't need to save for a college fund for you. McDonald's is waiting for you right outside of there. And my youngest actually put me on my toes. He said, Dad, is it the same allowance? I had to put extra money aside for this kid, right? Let's face it. We make a big deal about present value in finance, right? Take a look at your calculator if you have one. Notice the PV button starts to get worn out really fast. There are all these virgin buttons on the calculator. Have you noticed these buttons? You say, what the heck is that? E to the X, ln X. Those things you never use. PV. Because 90% of finance is present value. So you'd rather get the cash now rather than... So it has to be based on cash flows. It should reflect when you get those cash flows. It should have all side effects built in. Like what? Like strategic. We're talking about strategic. I'm going to put a number on it. You want to talk about synergy? I'm going to put a number on it. Whatever the word you're using, my job in finance is to bring it into the numbers. And I'll view it as a challenge, and I'll make you come up with qualitative factors that you think cannot be made into numbers. And over the next 3 days, we'll find a way to do it. There is no qualitative factor that cannot be converted into a number. I know that sounds like a challenge, but we'll come back to it, because I think that is the test, is can you bring it to the numbers. So you want to invest in assets and projects that earn a return greater than your minimum acceptable hurdle rate. That's the first principle. The second principle is called the financing principle. Remember I said there are only 2 ways you can raise money? Debt and equity. Every business has to decide, what's the mix for me? Notice the way I phrase that question. It's not the what's the right mix. Because there is no one right mix for every company, as you saw with Microsoft and Snapchat. And here's the financial principle that's going to drive how we think about that hurdle rate. The mix of debt and equity I should pick should be the one that maximizes my value as a business or minimizes my hurdle rate. See the advantage of having a lower hurdle rate? Having a 9% hurdle rate rather than 11 means you can take more investments. If I can find a mix of debt and equity that minimizes that hurdle rate, I'm going to do it. So even if you're not a finance person, as I go through this, step back and ask, does that make sense to me? And if you ask me what kind of debt should I take as a company, I'm going to turn the question back on you. So what are you investing in? If your investments are all in infrastructure projects with really long lives, your debt should be long term. If your investments are in assets that throw off cash flows in euros, your debt should be your debt. This isn't rocket science. Match the debt up to your assets. You say, but, my investment banker told me that. No, forget about the investment banker. He has his own agenda. You have yours. Match the debt up to your assets. That's a financing principle. Find the mix that minimizes your hurdle rate. Match the debt up to your assets. Then you get to the dividend principle. Here's what the dividend principle says. If you cannot find investments that make your hurdle rate, even if everybody else is taking them, give the cash back to the owners of the business. If it's a private business, what am I saying? Take the money out of the business. There's no glory in growth for the sake of growth. Take the cash out of the business. If you ask me, how should I return the cash? As a public company, you can't just take cash out. You've got to return it either in dividends or you buy back stock. To me, I mean, we make a big deal about buybacks being this strange and fantastic new development. It's a different way of returning cash. And maybe it's a more sensible way of returning cash than the way we've historically. It's not just that. Dividends really don't fit if you're raising equity. What's the essence of equity? It's a residual claim. It's whatever's left over, right? What's the problem with dividends? They become a fixed claim. You start paying a dividend, what do people expect you to do? Keep paying the dividend. Commodity companies, and we'll come back and talk, are going to destroy themselves over the next 2 years if they don't get out of the cycle. In fact, I was reading an article where BHP CFO was being interviewed about dividends. And the journalist asked, well, how long are you going to keep paying dividends? And he said, we will cut them over my dead body. To which my response to our BHP stockholders, that could be arranged. Right? But that's how stuck these in some companies, paying dividends has become almost an obsession at any cost. But if you go back to corporate finance, you pay dividends only if you have cash left over and you don't have investments to take. The investment principle, the financing principle, the dividend principle. And in doing all of this, you have a singular objective. Make your business as valuable as you can. Notice the coded word I didn't use. I didn't say maximize the stock price. That's a different judgment. Maximize your value as a business. That's it. I'm going to use this as a vehicle to lay out 5 basic themes, actually 6, that this class is going to be built around. The first is, nothing I've said in that big picture is from corporate finance, right? What am I saying? If you can raise money at 8% rather than 9%, please raise it at 8%. And once you've raised it at 8%, please don't invest that money at 6.5%. You're saying, I knew this already. Guess what? You all know corporate finance already. All I'm going to do is give you a structure to take what you know. And that shouldn't strike you as surprising. You know how old corporate finance is as a discipline? It's 58 years old. It can be traced back to a paper written in 1958 by Merton Miller and Franco Modigliani, 2 professors at the University of Chicago. That's when corporate finance was born. Before 1958, if you took a corporate finance class, it was a glorified accounting class. Thank God it's not 1956. How long have people been running businesses? As long as people have been around. I'm sure there's some very good cave business people. Fire, new innovation. I mean, I'm sure through time, and what I'm saying is through time, good business people have always understood these first principles. That's why you can be a great business person. Not just not have an MBA, but not even have gone to school. One of India's largest companies, Reliance, was founded by a guy called Dhirubhai Ambani, who was a 6th grade dropout. But brilliant business person because he got these first principles. Conversely, there are people with MBAs and PhDs, many of whom work in cities like this one, who think the first principles don't apply to them. Why? Because they're special. I went to Harvard. Therefore, first principles don't apply to me. I'll come back and talk about the damage that's created when people think first principles don't apply to them. So first thing, whenever you hear something and it doesn't make sense, process it. Don't say, oh, that's the way finance thinks. That should never be the answer. Make sure that you pass the common sense test. Second, corporate finance has focus. What did I say the objective was? Maximize the value of the business. Everything I do is going to be driven by that objective. So the investment decision, so everything I do, I know where I'm going. But it does come with a cost. The cost is, if you don't like the objective I pick, nothing I say is going to make sense. So that's part of what you're going to be wrestling with, is some of you will not buy into the objective I see in corporate finance. That's fine. What I would suggest you then start thinking about is, what is your alternative? Don't just say, I don't like maximizing value. You have to replace it with something else. Think through the consequences. It's focused, and because it's focused, if you don't like my focus, nothing I say will make sense. So that's the second thing. Third, talked about the life cycle. This is actually a picture of how I see the life cycle evolving. You have a startup, you have an idea company. Then comes a reality check. Can you make the idea into a product? That's the first transition moment as you go from idea to product. What happens for most idea companies? They go, the idea is a nice idea, but no, So now you pass that test, you got a product, you got to start building the business, right? You got to grow. Then comes the bar mitzvah moment where people say, when will you start making money? About another half the companies drop off there. You make it through the bar mitzvah moment, you start to grow. Then the test becomes, can you scale up? You know what I mean by scale up? You are successful as a small company, can you make it bigger? Again, a lot of companies don't quite make that transition. Now do you see why to get to that large market cap phase, you've got to get through all these barriers. So already when you look at a Microsoft and Apple, you're looking at a company that's made it through all these barriers. You think you get to enjoy the moment, and that's a harvesting moment, that mature phase. That's when you start to return cash to investors. Your growth starts to slacken off. And then there's a point, and this is your moment when you realize, and for me the moment came when I realized I don't jump out of bed in the morning anymore. It's a very dangerous thing to do. At 25 you can jump out of bed, you can roll out of bed, you can do flips out of bed. At my age, I put my feet on the ground and said, there is a ground. Then you stand up and say, I can stand. And then everything moves from there. I mean, that's that reality check when you realize you're not 25 anymore. And it's never easy. And then you have the decline. So I'm going to use the corporate life cycle as kind of a way of thinking about different companies as we go through. And you can think about where in the life cycle a company you might be looking at falls, or the company you work at. And corporate finance is universal. The investing principle, the financing principle, the dividend principle, right? Small businesses, large businesses, developed markets, emerging markets. Doesn't matter. Every business has to make these decisions. That's why I've never bought into the notion of you should have corporate finance for multinationals, corporate finance for US companies, corporate finance for small companies. This doesn't make any sense. This is like investing for doctors. Have you seen these books? Investing for doctors. There's a whole series. That doesn't make, as you're a doctor, your objective when you invest is different than when you're a lawyer or a business person. Corporate finance principles apply across the board. And I'm going to roam small to large, private to public, developed emerging markets. It is true that there might be special challenges you face if you're an Angolan company or a Zimbabwean company or a Venezuelan company, but the principles don't change. Your life is a lot more difficult because you face these macro issues, but that doesn't mean the principles change. And if you violate first principles, as I said, I don't care who you are, it's going to come back to bite you. I'll tell you a couple of stories to bring home how violating principles kind of gets you into trouble. A company called Steady Safe. Heard of it? It was an Indonesian taxi cab company in the early 1990s. No wonder you hadn't heard of it. And in the early 1990s, Indonesia was going through a spurt of growth. So this taxi cab company decides it's going to expand. It basically means it's got to borrow money, buy cabs, and put them on the ground. So you ready? You're going to be my investment banker for a few seconds, and I'm going to come to you for some corporate finance advice on what kind of debt I should take. Already there is, we'll talk about how many principles get violated along the way. First is, why did I decide to borrow money? So probably because if I issue equity, I have to give up this piece of the business. So already I've put control over, but I want to borrow money. I've made that decision. You're my banker. So I come to you and say, look, I want to borrow money. How long term should my debt be? You're allowed to ask me that question. So what's the question you're going to ask me to answer that? I'm going to buy taxi cabs with it, right? So you're going to ask me how long a taxi cab typically lasts, and it's about 10 years. So how long term should my debt be? About 10-year debt. What currency should the debt be in? See, what the heck is the Indonesian currency? I'll help you out. It's the rupiah. I operate taxi cabs in Jakarta. People don't pay in dollars or euros. They pay in rupiah. So I should be taking on 10-year rupiah debt. Simple. So let's play out what actually happened. 1992, SteadySafe goes to Peregrine. At that time, one of the leading investment banks in Asia. It's not the Peregrine that you might read about now. It's a different Peregrine. And they said, well, we want to borrow money. What should we do? They said 10-year debt. They got that half of the equation right. But they said 10-year US dollar debt. Why? Because the interest rate on the debt, and that's exactly the word, cheaper. You violated a second principle. Why? Is 12% debt cheaper than 20% debt?
No.
It depends on the currency. In fact, I give the analogy of leaving Frankfurt on a plane and checking your weather app. And it says the temperature right now is 20 degrees. And landing in New York and checking your weather app. And it says 68 degrees. You say, oh my God, I've landed in Venus. What's the problem? You left Europe, you're in Celsius. That's the same way. And I want to kind of re-emphasize it. We've become incredibly sloppy about the way we talk about different currencies. It is true, a 12% rate looks lower than a 20% rate, but if the 12% is a dollar rate and the 20% is a rupiah rate, we're comparing apples to oranges. But that's the advice they got. And SteadySafe said, if that's what you're saying, we'll borrow in US dollars. And they did ask a follow-up question. You've got to give them credit. They said, well, shouldn't we be worried about the fact that we're borrowing in dollars and taking all these investments in rupiah? You know what the bank told them? Don't worry about it. The exchange rate is pegged and nothing bad will happen to you. What does that mean, pegged? Basically, they've set it at a fixed rate and the government has promised us that nothing bad will happen. Famous last words, you go out and borrow money in US dollars to fund rupiah projects. And for a few years, things go remarkably well. Then you get to 1996, and the Indonesian government that had promised that nothing bad would happen did what? They devalued the currency by 70%. So let's wake up to the morning after. You're SteadySafe, you look at your balance sheet. All your assets are rupiah assets, right? So in dollar terms, they were 30% of what they were yesterday. Now if you'd borrowed all your money in rupiah debt, that would be remarked down. You wouldn't have been happy about what happened, but you wouldn't have been in any trouble. But unfortunately, you borrowed in US dollars. So guess what happened to SteadySafe?
Debt goes up by 70%.
Forget about debt going up. You are bankrupt. The only good thing that came out of this, right? The only good thing that came out of this is they took their investment banker down with them. If you ask me, it happens far too infrequently. Investment bankers are always there at the wedding, they're never there at the divorce. Actually, let me take that back. The wedding planners and divorce lawyers rolled into one. They're at both places collecting fees. For what? But you can see this played out over and over again every time there's a crisis. You see The Big Short, the movie? See it when you get a chance. I think it gets part of the problem wrong. It blames the wrong instrument. It says mortgage-backed securities caused the 2008 crisis. Really, you know what the problem that created the 2008 crisis was? Not that you were lending to subprime people, but that you were not charging a high enough interest rate. That's at the core, that's what it was, is that we were lending to people with bad credit at too low a rate. And when that happens, of course, I mean, essentially it's like collecting 10,000 people in a room who have credit problems, lending them all money, running a model that shows that nobody will default in that room, and trusting that model. That's basically what investment banks did. And they said, oh my God, these people are defaulting. When did that start happening? Well, that's exactly what you should expect. First principles violated. So I would caution you, because remember, if you're running a business and you're looking outside for advice, you know what I mean by advice? You have consultants, you have bankers. They have no qualms about violating first principles with you as long as they collect a fee. It's your money that's at risk. So that's again something I'll come back to repeatedly through this class to remind you of first principles, because it's something we can't let go of, something we can't take our eyes off. Which brings me to my final theme for this class. I told you this was an applied class. Now I'm going to make it real. Everything we do in this class, I'm going to apply in companies. Here are my companies that are going to be my lab experiments for the next 3 days. The first is Disney. All familiar with Disney, right? Entertainment company. Lots of different business. Broadcasting, movies. It's a developed market entertainment company. And I'm going to take it through the entire process. Like when I talk about hurdle rates, I'm going to estimate Disney's hurdle rate. When I talk about returns, I'm going to measure Disney's returns. When I talk about the right mix of debt and equity, I'm going to come up with that mix for Disney. When I talk about how much can the company return to its stockholders, I'm going to look at Disney and how much it can return. So everything we do, I'm going to take through. Yes?
What the fourth principle that it fits for all? What about
the principle fits for all. The practice might have to be varied across companies. Okay? So you're going to see me do the same principle. So in fact, at the end of this page, if you have the same question, we'll come back to it. Because each of these companies, you can look and say, there's no way you're going to be taking the same approach to value Baidu as, but you're going to see that the principle is the big picture question. That's something that's not going to change. But the way that principle plays out will actually vary across these companies.
Actually, my question was a little bit larger. Does it apply to government and social costs? And what about the non-profit?
Let me ask you a question. Let's start with the government company. What's your objective? Any of you work at government companies? You don't want to admit to it? If you're a government company and you put the CEO of a government company, what's your objective? What's your end game? What are you asked to do? You're asked to do this. You say, make money. By the way, I also want to hire those 300,000 people in that state that don't have jobs. And by the way, while you're doing that, make sure that, and you see already the problem with managing a government company. You have 6 objectives pulling you in different directions. If you have 6 objectives, it's like serving 6 masters. You know what's going to happen? You're going to make none of them happy. In fact, I have on my website what I call, one of the pictures I'm proudest of, and I'll show you this picture later in the class when I get a chance. It's a picture of Petrobras. Petrobras is a publicly traded Brazilian oil company. But it's a publicly traded Brazilian oil company only in name. It is really a government-run oil company. So if you're the CEO of Petrobras, you know what you were told 5 or 6 years ago, or maybe 10 years ago? What did the Minister of Finance tell you to do with Petrobras? Make your company a symbol for the nation. Make it the largest oil company in the world. Okay? So let's see, how do you make yourself the largest oil company in the world? You go looking for reserves. Does it matter what it costs you to look for these reserves? It doesn't matter. You want to be the largest, not the most profitable, not the most valuable. So step 1 in this process is your objective then drives the fact that you invest in everything. That's the first thing that Petrobras did. It kept investing in new reserves even though the costs were getting out of control and their profits were shrinking. You've got to come up with money to fund these reserves. And the government says, make sure you don't issue any new shares because that's going to dilute our control. So if you can't issue new shares, how are you going to come up with the money to? They borrowed money. They borrowed money like it was going out of style. And then the government said, oh, by the way, all these people who bought these non-voting shares in the company, to keep them non-voting, you have to pay big dividends. So you've taken all these projects you shouldn't be taking. You're funding them with debt you really can't afford. You're paying dividends like you're a mature business. In fact, if you were thinking about a company that violated every principle in corporate finance, this is the anti-good company. Say, if I were creating a company from scratch that was a perverse counter-example to how a good company would be, Petrobras would be it, right? But you know what? It makes sense if you think about what that starting mission is. So if I were advising a government company, the first thing I would tell them is, be careful. Not private, it doesn't have to be private because that might not be practical. Be careful what that starting mission is. Unfortunately, that's a political as much as a business decision. So I could create for you a corporate finance pathway given your mission, and with Petrobras, the end game will be you'll accomplish your objective. You'll have a lot of oil coming out of the reserves, but in the process, you'll wipe out $200 billion of market cap, which is what Petrobras did. So with government companies, that is often the issue. With non-profits, again, this is again the issue. Unless you're clear about your objective, everything else is going to unravel. My wife works with this non-profit near where we live, which works with the homeless, and she's on the board. And when they meet, they've been going through their mission statement. In fact, they didn't even want it. They said, why can't we list out 10 different things? I said, no, you got to push them to have a mission. And initially the mission was to serve the homeless. And I said, that's not going to work. You got to say, what is it to get homes for the homeless? Because that could be a mission. Is it to provide temporary help to the homeless? You got to define your mission. You see why you need that? Because you have limited resources, right? As a nonprofit, you got to spend that $500,000 where you think it'll have the biggest impact. Unless you tell me up front where you're going towards, you know what's going to happen? Every decision is going to be made differently because each person making the decision brings their own vision of what does it mean to serve the homeless? Extraordinarily dangerous place. So even if you're not a for-profit or a publicly traded company, what I would say is you need to have focus. You need to find an objective. In fact, in my next version of the book, I'll probably throw non-profit into the mix as well because it is an issue that they face. It's the same kind of decision process. So the first company I'm going to look at is Disney. The second company that's going to become a company that runs through is a company called Vale. It's a Brazilian mining company, but it's Brazilian only in name. It's really a global mining company. It's the largest producer of what? Iron ore in the world. Its biggest market is China. And that's another point I want to make. For too long we've had this lazy characterization of where you're incorporated, or you're a Chinese company, you're a Brazilian company. There are no Brazilian or American or European companies. Through the accident of history, you might be in a country, but you are really a global company. Vale is a global mining company, but it's going to allow me to look at what happens when you're incorporated in an emerging market. And like Petrobras, Vale has a government problem, a government player. So we're going to talk about how that's going to affect corporate finance. The third company I'm going to use is Tata Motor. Familiar with Tata Motor? It's an Indian automobile company, part of one of India's most famous family groups called the Tata Group. But the reason I put the quote on the Indian was about 5 years ago. It bought, actually 7 years ago now, bought Jaguar Land Rover. So it's an Indian automobile company. It's really a global company. Its biggest market is China. This is going to become a recurring theme. And now you see why the unraveling of China is not a Chinese problem. It's a global problem. We're paying a price for all those China stories we've been told for the last 15 years. They're coming home to roost. But I'm going to start a motive to talk about what's different about corporate finance when you're part of a family group. You think, so what if you're part of a family group? All of the Tata companies, and there are dozens, have one headquarters building in Mumbai. It's called Mumbai House. So the second floor is Tata Motors, the third is Tata Steel, fourth. And at the very top of the building used to sit Ratan Tata, who runs Tata Sons, which is a private business, which actually, you see why this is going to play a role? Is in Tata Motors, when decisions get made, the question that I have to ask is, are they being made with the end game of making Tata Motors the most valuable company, or are they being made to make the Tata Group more valuable? And that is going to be a problem we're going to face all the way through. But I want to bring that to the surface, because across Asia and Latin America, this is the rule, not the exception. Then I'm going to talk about Baidu. What does Baidu do? Any of you been to China? How many of you? I remember landing in Shanghai and trying to open my own blog. And it said, we can't find it. Then I said, I'll go search for it. I open up Google search, can't find it. I said, what happened? What universe have I landed in? You know, any Google related thing is not directly accurate. You can get through to the VPN. No. Baidu is basically the Chinese version of Google. The only reason it survives is because Google doesn't, You say it's a Chinese company, it's actually incorporated and traded on the NASDAQ. You know why? Because the Chinese actually have a law that treats technology companies as in the national interest. Scary words if you're an investor. The words national interest already knock off 30% of your value. Okay? You're not allowed as a foreign investor to invest in a Chinese technology company. So how come Baidu got around it? When you buy shares in Baidu, you know what you're buying shares in? Not the Chinese search engine, but a Cayman Islands shell company. With an operating agreement with the Chinese company that's technically illegal. Keep that in mind. So for the moment the Chinese government is looking in the other direction, saying, yeah, it's too much money at play. But if tomorrow the Chinese government says this agreement is illegal, what do you own shares in? A shell company in the Cayman Islands. I don't even know whether they have a board hanging up there, but you can try to sell the board on eBay and say, how much is that worth? Hey, you know what? Alibaba is structured exactly the same way. So I want to use Baidu to talk about what happens not just with an emerging market company. If you talk about corporate governance problems, this is corporate governance kind of in spades, right? You have absolutely no control over how this company is run. And this is playing out in Chinese company after Chinese company. I want to talk about Deutsche Bank. Why? Because banks bore me. And I'll be quite honest, banks bore me because there's not a whole lot of room for you to make corporate finance decisions. Like what? Remember that question of how much money can you borrow? First, when banks borrow money, it's not a source of capital, it's raw material. So it's not even clear what they're borrowing. Second, you can't just go and borrow money, as much money as you want, because you have regulatory capital restrictions on how much you can, how much you need as equity. And you can't just, so every decision you made is constrained. Now I want to use Deutsche to kind of talk about how different is corporate finance when you're operating in a straitjacket. Financial service companies, you are in fact operating, where you invest, how much you borrow, how much you're already put on a pathway. You can deviate from the pathway, as some banks do, but nothing good ever comes out of that. And then I'm going to close with the company called Bookscape. It's really not a company. It's a privately owned bookstore in New York City. Small independent bookstore. It's a private business. You say, but that's not a company. It's a business. Remember I said corporate finance is universal? I'm going to talk about what's different if you're the sole owner of a business, of a small business. You have to make investment decisions, financing. I almost used that hot dog stand that actually is outside this building. The guy's not here actually this week. But this guy was, for 20 years, he's had this stand. And I know the guy, so I remember last year, he used to stand outside the stand and make the hot dogs and stuff inside. And last year, he had this nice stand where he's inside, which is great in the winter, you're not outside. So I asked him, that's not, you have a nice stand. He said, it cost me $50,000. Big investment decision? Huge. And if he screws up on the decision, what happens? He's too big to fail. No, I'm just kidding. He's not too big to fail. He's really small, so he failed. So it's actually bigger for him than when Disney makes a new movie. Did he have to borrow money? Yes. And does he have to face a dividend decision? He's got 2 kids going to college. How do you think he pays for them? The cash out of the business. Investment decision, financing decision, dividend decision. So I'm going to close with this before I break. If you think you're going to sit and watch me play through these companies, you are right. But you're also going to be working with your own company. That's a company I sent you. You are going to be doing everything with your company that I did with these 6 companies. So that's your big project, is you're going to be replicating everything in this class in your company. And you're going to hit dead ends because you have some companies that are strange. And for some of your companies, things will happen. Like what? Your CEO might be arrested for something that happens in the next 3 days. Nothing you can do. That's life. You've got to work with whatever happens. So this is going to be your lab experiment. So let's take our break, and when we come back, we're going to launch into the rest of the class.